Hello everybody, it's Chris Darbyshire and Tom Sheridan here to do a review of the Q3 asset allocation discussions from 7 Investment Management. And before we start that, what I'd like to do is just to put up the chart of 7IM and what it is that we're trying to achieve, which is to hit the expected returns for different levels of risk over medium to long term. And by that we mean periods of 5 years or more. And if you see down the bottom of the chart, it's got numbers 5, 6, 7. What that means is if you were invested for 5 years or 6 years or 7 years, that those would be the annual compounded, not average, compounded returns after cost that you would have received as a 7IM investor. And the message is it's doing more or less what it says on the tin. So what we're trying to do now is to keep that going for the next 10 or 15 years. And Chris, your view, if I understand it correctly, is best judgment to hit those returns right now is take a little risk off the table.
Yes, we've been through an exceptional period of returns in markets, and that's really helped the portfolios get above that expected return threshold. Most of them are comfortably above as we sit here today. And we're just becoming a bit concerned that the markets have gone too far relative to the economy, relative to the risks that are out there.
So valuations are pretty high, but here we are looking at US equities, for example. We've had the best earnings season that we've had in 12 years. Capital expenditure finally hitting the radar screen again, and you want to take risk off. What are we doing?
So it has been a good earnings season, but it's been specific to certain sectors, and the CapEx recovery that we're seeing in the US economy is really all about the energy sector recovering from the collapse in the oil price of 2014, 2015.
Right.
More broadly, economic growth is no better than it was several years ago, and earnings growth, when you take out those sectors that have done very well, is nothing special. So I think what we will see in Q2 when those earnings numbers are announced is whether the earnings are able to confirm the market's quite high expectations.
Right, so the chart that we're looking at right now shows that the market, the S&P has done really well, but the surprises, the economic surprises have plummeted. What are those surprises and what's the relevance to our view?
So that surprise index measures whether economic data being announced is better or worse than was expected at the time. And we're seeing more and more now that the economic data in the US is weakening, it's underperforming expectations. And it's really hard when you look at that chart to understand how the market can stay up that high without very good earnings growth. But it's hard to see where the earnings growth comes from if the economy isn't firing on all cylinders.
And indeed the valuations are already pretty high, aren't they?
Valuations have priced in some very good earnings performance. So we think the risks are on balance now to the downside.
So we go from this fairly lovely, aggressive picture in the equity markets, and we look at the bond markets, and they've been telling us a pretty different story over the last couple of months.
Yes, they have. They've been reverting back to levels that were around before Trump was elected. So we had the Trump boost with some expectations of policy change, but that is falling back as it becomes apparent that Trump is really going to struggle to get these big initiatives done. And bond markets are telling us that maybe growth isn't going to be as good as the equity markets think it is.
Of course, there'll be some people who tell you that Trump not being able to get anything done is probably good news, but that's a story for another day. In addition to looking at the equity markets and evaluating what lies ahead, reading what the bond markets are telling us, you and the committee, I know, spent a fair bit of time on tail risks. Now, the tail risks that we had been looking at in the beginning of the year were very much political, election related, whether it was in the States or whether it was in the UK or whether it was in Europe. And we seem to have gotten through all that, and the equity markets really didn't flinch. What kind of tail risks, and by the way, tail risks are small probability events that would have a big impact on the portfolio. What tail risks are you looking at, and what are we doing about them?
So we're really looking at geopolitical tail risks now. We had the good result in Europe with the French election, so I think the sort of pure political risks are off the table. But we're seeing an increased level of geopolitical risk globally. It all seems to centre on America, and in fact Trump is the epicenter of this, whether it be versus North Korea, falling out of favour with NATO and with European leaders, or indeed in the Middle East, where the environment is becoming more polarised again, having been through a good phase over the last few years. We're seeing geopolitical risks elevated around the world. It's hard to see how these play into portfolios, but the nature of a tail risk is that you don't know what it's like and what impact it will have until it happens.
Yes, and then you can look back with 2020 vision and say, I should have seen that coming. There's another kind of tail risk that you and the committee have been looking at, and it may be a tail risk that other investment managers are not really looking at the moment, and that's the cybercrime risk.
Yes, we had the WannaCry attack on the NHS and other governments around the world recently. And this is just one of a number of viruses that were unleashed by a hack of the US databases last year. And these viruses, some of them are more powerful than WannaCry, are still out there. And there will be at some point a cyber attack that is so large and so effective that it does disable parts of the economy and could well have a knock-on effect on markets.
And you would think that if it did, it would be very sudden and very sharp, and if you weren't pre-positioned for it, you wouldn't be able to catch it.
It's pure tail risk, and there's really very hard even to position for it.
Okay, so currencies have figured very prominently in the 7IM discussions over the last couple of years, and we're still in a position where the prominence is the same, although the view may be a little bit different. Talk to me a little bit about sterling and what we're looking at in the portfolios.
So we're still very, very focused on sterling risk, and in particular the risk that sterling rises as the threats associated with Brexit go away. That's going to have a negative impact on the foreign currency positions in the portfolio. So we're very, very sensitive to that. And with the election, I think having given a vote of no confidence on a hard Brexit strategy, I think we're going to be drifting towards a softer Brexit, which prioritises continuity of British business, which will be perceived very favourably by the currency markets.
So how perverse? You get a poor election outcome, which turns into a stronger reading for sterling. Welcome to the world of politics. Now, Chris, what is it that we're doing in the portfolios right now? You can see a chart here on European equities. Talk to me not only about Europe, but talk to me about the developed world in general, and then emerging markets.
So we're underweight US, UK and Japanese equities. We've moved underweight US and Japan recently. UK, we really just want to avoid Brexit and the unknowns that come with that. We're overweight European equities, where you've got a somewhat improving political situation, but also you've got a very good economic situation in Europe, where Europe is actually, by its standards, firing on all cylinders. And then finally, in emerging markets, we still like the story in Asia. We still think Asia's got plenty of potential growth, and that will at some point be unleashed. So we have a longer term positive view on Asia, which influences the portfolios a bit.
And you've done something a little different in the very aggressive portfolios.
Yes, we've added frontier markets to the more aggressive portfolios. These are markets that are less developed than emerging markets, such as Vietnam, for example, but where there are interesting, trade stories out there. They are trying to develop, and they have capital markets that are sufficiently sophisticated that we can make an investment.
So we're painting a risk reduction picture in the portfolios right now, and yet the levels of cash are going down. How do you reconcile that?
So the cash is going down, and that's partly due to an increase in US government bond positions, where we think there's a bit of yield available in treasuries. And if we're right about markets and the state of the world, then treasuries might make a bit of money. But also because we're increasing our alternatives allocations. These are the parts of the portfolio that are on the whole uncorrelated day-to-day with equities, and may act as risk mitigants if things become a little bit uncomfortable. Among them is gold. So we've added 2% to our gold allocation in the balanced portfolio, which is now up to 7%.
Which is probably as high as we've ever been in terms of gold positions. So in terms of risk mitigation, the treasuries, gold, the alternatives, we have about 10% in market neutral alternatives. What are those? And maybe give me an example of one of them.
Yes, so these are investments that are not like bonds or equities. They won't move in the same direction as bonds or equities, and if there is a sell-off in either one of those big asset classes, they will help to stabilise the portfolio. To give you an example, we hold an investment that will go up if market volatility increases.
Great. So there we have the equity picture, which is a bit off the table. Cash invested in risk mitigation investments such as gold and treasuries. And the picture from 7IM and the summary really and the message for you is still looking for the expected returns over the medium to long term. And to achieve that just at the moment, we think taking a few profits and putting them in the piggy bank and taking a little risk off the table is the way to go. Thank you very much, Chris, for doing a great job, and we'll see you again in 3 months' time.